Funny thing happened this week. The Federal Reserve came out on Wednesday with their meeting minutes from the meeting that they held a few weeks back at the end of July. And the minutes outline exactly what they talked about during that meeting. And it made it really clear the Fed thinks they're going to have to start lowering interest rates next year. What the heck is going on? How in the world is the Fed right now raising interest rates faster than they've ever been raising them in 30, 40 years? And now they're turning around and saying, okay, now we think we're going to have to lower them next year. Well, let me tell you what's going on. It is exactly what I've been saying for the last 6 months, which is that the Federal Reserve is raising interest rates quickly in order to put out the raging inferno fire of inflation. But the reality is, as soon as that inferno of inflation is tamed down, we're going to have a bigger problem. And that problem is going to be recession. And so I want to give you a quick primer on what that's really going to mean to you. I've talked about it a lot over the last few months, but I want to be really, really clear. A recession is the decrease in the economy, in the amount of goods and services that are traded, exchanged, things that people create and sell, services that people pay for. And a recession is when things slow down and you have less activity, less goods and services that are produced or sold in the United States during the period of recession compared to the most recent period. And typically we're talking about quarters and years. So compared to last quarter and compared to last year. So why does that matter? Because the Federal Reserve is raising interest rates in the attempt, with a purposeful intent, to stop companies from spending money, to stop consumers, you, from spending money. They're doing that because inflation is crazy because there are too many dollars chasing too few goods. And so how do you stop that? You either get more goods, that's called supply side, or you decrease the dollars, and that's the demand side. Well, the Federal Reserve can't control the supply side, not directly, but they can control the demand. By raising interest rates, they're lowering demand. It's exactly what's been happening with the housing market. We've seen interest rates go up, and therefore demand has been going down. But the housing supply has not changed. So as soon as interest rates come back down, and the Fed has already said they're looking at next year to lower interest rates. So as soon as interest rates come back down, we will be in a recession and we will see demand go up again. We'll see demand go up for housing. And what the Fed's afraid of is they want to make sure that they have what they call a soft landing, because they could be bouncing back and forth and they could lower rates to stop a recession, but then they turn around and start having more demand, which creates an inflation problem. What does this mean to the housing market and the mortgage industry? It means, first of all, mortgage rates are highly volatile. We've been seeing rates stabilize within a range. So we're seeing between 4.75 and 5.5-ish on average for the best qualifying clients. But the difference is huge volatility within that range. Now, the good news is we're not at 6.5 like we tickled late spring. So we've come down some, but we still have a lot of volatility. And I think we're going to see that same volatility through the end of the year. So buckle up. Don't fret about, hey, where are rates today or tomorrow? If you're buying a home, it's a great time to buy because you have the ability to pick the home that you want. You have the ability to actually do inspections and take time to double check and make sure there aren't problems with that home. And when interest rates come down, which we're now thinking maybe a year from now, you won't be in high competition with all the other people that are finally coming back to the party and wanting to buy homes. And you're able to instead refinance at that time and take advantage of a lower interest rate. So just be aware, the Fed is already starting to say they're going to be lowering interest rates likely next year. That affirms everything I've been saying for the last few months, that we are in a highly volatile cycle, but it's going to be a short one. And things are moving up quickly in interest rates, and we're expecting to see them move down. Please check out all the rest of my videos on my playlist. I've got a lot of great videos, little short videos this week, a lot of them on snippets of things that you really should know. Hopefully you like them. You can share them. The link is down below to the playlist if you don't see it over here on the right side. Give me a call if you need anything, and hope you have a wonderful weekend. Bye-bye.